presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for April the 1st, 2024. I'm Mo Ansari, President of Compak Asset Management, and it's not April Fool's, folks. I know it's April 1st, but what a wonderful quarter we had. In the markets, S&P up over 10%, NASDAQ over up 9%, and the Dow also up nearly a little bit over 5.5% for the quarter. One of the best quarters we've seen since 2019. So where do we go from here? That's the question I'm going to try and answer for you today. But don't forget to subscribe to this YouTube update, so whenever I post an update, you will be notified and you will know that you can come and take a look at the charts. I talk about that quite a bit of detail. We will talk about that, Javed and I will, on the podcast, which is a much longer version of the update. What happened fundamentally to the markets, where we headed, and all of that will be answered in the podcast. And I will talk about the charts on the podcast. You can't see them, but you can see them here. So subscribe to this. Subscribe. Just go to compak.com/media and subscribe. Just put your email, so whenever we put the weekly newsletter that we put out, it's just a one-pager. And whenever we do updates, podcasts, all the events that we do, all of them are free. They are to inform you, to make sure that you're making informed decisions. The more information you have, the better decisions you can make about your financial future. So make sure you go to compak.com/media and subscribe to it. For the week, S&P was up 0.4% for the week. We did quarter 10.5% for the quarter. Wonderful quarter. Dow Jones up nearly 6% for the quarter. And then we saw the NASDAQ up about nearly 9.33% for the quarter. It was down for the week, the NASDAQ was. Again, I think the markets are fully priced. We did get the PCE, that's the Personal Consumption Expenditures Index. I know it's a mouthful, but that's the inflation, that number that the Fed watches. I know we look at the CPI, the PPI, all of those numbers, but the PCE is what the Fed pays attention to. And after it came out on Friday, Mr. Powell, the chairman of the Federal Reserve, came out and said, well, the economy is doing great, unemployment is holding up, so everything is good. What that means is they don't need to make as many cuts. I know we went from 6 cuts that the market was expecting last October to now we're at, the Fed will not cut at all, as I said a month and a half ago, that I still think that we are going to get interest rate cuts. It just depends on how slow the economy gets. If it does slow down at all, if unemployment starts to rise at all, the Fed will be very quick to bring rates down. I still think 2 to 3 cuts are in the cards by the end of this year. Now the market is saying no more cuts, no cuts for this year. They've gone from one extreme to the other. Once they reach that extreme, that's when the market starts to get nervous, and that's when we see the correction. So we're overdue for a correction. I've been talking about that for the last 6 weeks or so, but the market continues to march. And that is the biggest problem that people make, is to sell too quickly. They're too quick to sell when the markets are going up, too late to sell when the markets are going down. That's what most people, when they're making emotional decisions, do that. So I think, again, trying to pick a top in the market, which is very difficult to do, or trying to pick a bottom in these markets is very difficult. People who sold out at the beginning of last year, at the end of last year, beginning of this year, market can't go higher. It's had one of the best quarters that you've missed in 4 or 5 years. So that's why picking tops and bottoms is a problem. Having a balanced portfolio that has the shock absorbers built in so you can handle the volatility when the markets do go up and down. Utilities were the best sector last quarter or last week. Technology was the worst. That is usually a turnaround that we've seen. We don't see that usually. Oil continues to move higher. Today it's up big on some strikes on the Iranian consulate in Damascus by the Israelis. That's what is expected. Israel didn't say that. But that just increases tensions in the Middle East. That makes oil go up. Also, economies around the world are doing good. Chinese numbers came out this morning. They were better than expected. So I think the demand that everybody is worried about, that as the economies slow down around the world, the demand for oil would go down. It has not happened yet. That's why oil is holding up. And also OPEC is holding barrels back off from the market. They might start to bring some of those barrels back. We'll have to wait and see. Treasury yields, 10-year, started at 4.22 the week before, ended at 4.2, but today we are at 4.3. So we have popped up today in the 10-year, and that is what is putting pressure on the market today overall. Looking at the best asset classes, returns for the first quarter, U.S. large cap, that's the S&P, up 10.6%. Developed market equity, up 5.8%. Small caps also coming to the 5.2%. So those are the biggest. S&P still, U.S. large cap, still leading the way. And that's why I think having a U.S.-centric portfolio in large cap is paying dividends right now. We did see new home sales that rose less than expected, 662,000. Case-Shiller home prices up 6.6% year over year, and the fourth quarter GDP was revised upwards to 3.4. So economy is doing great. This week we get the ISM today for March, expected to be around 48.3. Construction spending up 0.7. Factory orders come out tomorrow, up 1%, looking at somewhere around 1%. Then we get car sales. ISM non-manufacturing comes out 52.8, slightly lower than what we got previous of 52.6, so 52.8, slightly higher than expected. Trade balance, then we get non-farm payroll. That's the big number. That's the unemployment number for March, comes out on Friday. Previous numbers 275. Expected that to slow down a little bit to 205,000. We'll have to wait and see if it comes out around 205. That means the growth in jobs is slowing down, which could be good. It'll bring the fear back into the Fed that, oh, economy's slowing, we better cut rates. So I think we will go somewhere. I'm still expecting, no one's expecting rate cuts now in June. That's when the next Fed meeting is. I think I would not be surprised to see one. We'll have to wait and see how the numbers come out between now and then. We're looking at, again, don't forget to subscribe to all of these podcasts, YouTube updates, all of the weekly newsletters. All of it is free. Learn. Spend some time before you spend any money. Let's take a look at the charts. Market continues to move up. Wave 1, wave 2 to the downside, wave 3, that's where we are. I think we're fully priced in wave 3. Support now at the 20-day moving average, which is 51.77. We're trading at 52.38 this morning. And then we have 5,056. That's the 50-day moving average. I would not be surprised to see 5,000 at all on the S&P. I know we're close to 5,300 this morning, 52.64. 63 was the high this morning. So, we get 250 points down, 400 or 500 points, 4 or 5%. That's a good pullback. It's not even a correction. Correction is if we get much below the 50-day, that's when I would start worrying about a deeper correction and bringing us down to somewhere around, right around here, which would be 4,800. That would be about somewhere around 10%. That would be a correction if we do get that. I don't think we are in for that, but we'll have to wait and see. That's right now. But don't try to pick a top. That's one thing that so many people have been trying to do. Don't do that. Just have the correct allocation and just have a little bit of powder dry just in case. Looking at the weekly charts, wave 1, wave 2, wave 3. Fourth wave, again, takes us to 48.84. That's the 20-week moving average right here. That's why I think 5,000 to 4,900, somewhere around there, would be a good wave 4. And then a wave 5 to the upside is what I would be looking for. Looking at the NASDAQ, it is at a wave 5. It is fully priced. 20-day is 16,223. We're at 16,372 this morning. Below that is 15,888. That's the 50-day moving average. And then, major support is right around 15.2. That would bring us down about 1,000 points, a little bit more than 1,000 points from where we are now. Looking at the weekly charts, long-term target still 17.1 to 17.750, but we are at a fifth wave. But the fifth wave target is right up here. We got close to it, but we're not there yet. So pull back 20-week moving average, 15,491 or about 15.5, and then the 50-week moving average is 14.2. We are, as I mentioned, right around 16.3 this morning. Interest rates, big jump up today. 12 basis points for the 30-year bond, trading at 4.32 this morning. That's a big jump up in rates. You can see this big green line right here, and that's a big jump up. The 50-day yield average is 4.223. We're just hovering right around here, this rate to this rate, trading in this band right here. If we get much above 4.4, that could put us somewhere around 4.7. That would be the next resistance on the charts right here. And I think that would scare the heck out of the market. If we get much above 4.5 for the 10-year, we're at 4.32 this morning. Crude oil, as I mentioned, big move up, and then another move up today because of the tensions in the Middle East. Small cap, 208 to 210 was the target. We got as high as a little bit above 210, got nearly to 212 intraday on Thursday, and then today we were up this morning about 210.77, but right now trading around 208. I still think we are fully priced here, fifth wave top, 20-day 205, 50-day 201. I would wait till about 201 to add small caps to your portfolio. Those are my thoughts. Those are what I'm thinking. If you want a much more detailed analysis, Javed and I will be on the podcast. Make sure you subscribe to it. You will get it absolutely free. Again, if you need help with your portfolio, just go to invest@compak.com. Send us an email. We'll set up an appointment wherever you are. We'll do an analysis on your portfolio. We'll sit down with you, spend an hour with you. It's absolutely free, and share with you our thoughts. You've been listening to me for the last 40 years nearly. If you want help, we will be there to guide you, to get you to your financial destination. Invest@compak.com. Thanks for joining me today. I will be back with you on next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.